Welcome to Oregon Cash Flow Pro. My name is James Barber. As always, I'm here to help you maximize your cash flow. I appreciate you guys joining me. I don't say this near enough, but it's really the support that I get from this channel and seeing all the people subscribing and liking the videos and interacting with me that tells me that I'm giving you the value that makes it worthwhile to put all this content together. So thank you. Thank you so much. And just know if you ever have comments or questions, I'm just starting it. We just started. So if you ever have comments or questions, just put them in the chat. Whether you're watching this video later on or you're watching it live, I always do my best to answer every question that you guys have. I do one-on-one consultations. I do free consultations. I do paid consultations. Um, Basically, whatever you guys need, I'm here to try to help you as best as I can. Most of what I do is free of charge. Some people opt to go for the paid consultations, and I appreciate that if it warrants it. But just know that I'm available, and it's all because of the support that we get here at this channel. So I want to make sure that I'm always providing you with the best content that we can. Today, we're just going to go through and look at the comments that people have left recently. And I've answered, I try to answer all the questions in there, but sometimes I hold off and I say, you know what, I'm going to do a video on that one. But we're going to go through, we're going to look at each of these comments made in the recent past here. And we'll see how this gets received. And maybe we'll keep going back, keep looking at it, try and make this a regular feature. Because I really want to encourage you guys to leave the comments if you have them. I have probably 600 plus videos out there, and it's really hard when you're trying to get information on this stuff. You're not going to watch all of those. Who's got the time to watch all those? So some of the stuff we have to talk about over and over so that it's fresh, so that it pops up in the feed and YouTube recommends it and you're able to view it again without you having to go look for it, right? So hopefully by digging into these questions or by you just asking the question that you're trying to get answered, because what led me to getting started with this YouTube channel and these videos was I saw about the infinite banking concept. I had seen about velocity banking, other things like that. And I wasn't quite getting the answers I needed from all the videos that were out there. It's like they were just teasing me with marketing stuff, but they weren't really giving me the details that I needed to be able to quite understand how this stuff worked. And so I thought, you know what? I'm going to go in there and I'm going to do that. I'm going to provide the missing information that I'm looking for, because surely other people are out there looking for the same stuff. And it's that transparency that I think is what led to the success here of this channel. What brings people to me and to this channel is that we're gonna be totally transparent about everything we do, and I try and reveal as much as I can about everything that I do. So let's hop into the questions that people have left, and feel free to leave questions in the chat if you've got them as we go through this. So here we go. We're just going to start going through these things. Lonnie asked, can I get an illustration where it changes to option A at a certain age? And you can see my response here. Yes, you can. You can choose any age to make that change in an illustration. And then I gave her some information so that she could schedule a meeting with me and take a look at what that actually looks like. Now, when it comes to the designs, if you've been following my channel and you watch how we do these designs, an illustration is a projection of what's possible. This is one possible scenario that can happen, and we can choose what inputs to put on it up to certain limits. So there's restrictions as far as how much we can project, how much rate we can assume is put into it, things like that. But when it comes to changes that happen later on in a policy, we get to decide where to put those changes in these illustrations. And it's generally not something that's going to happen automatically. Most of the changes that you see in an illustration are just showing you what's possible with that product. So that's why I said you can choose any age to make that change in an illustration. Here, let's see if I can highlight that. You can choose any age to make that change in an illustration. Generally, we look to make a change from an option B to an option A. An option B is a increasing death benefit. Switch to an option B whenever we decide to stop funding it or permanently reduce our funding. Because oftentimes our designs are meant to have just enough death benefit for the amount of money that we're trying to put into this. The death benefit determines our MEC limit. So if we're going to reduce the funding, if we no longer want to put money into it, that might be a time where we consider reducing the death benefit and reducing that MEC limit because we don't need that space anymore. Now, in general, that's something we look to do around retirement. It could be different with a kids policy. With a kids policy, you may want to fund it for 10 years and then stop. And that policy is still going to be in force for another 50, 60, 70 years. Well, you don't necessarily want to reduce that MEC limit to zero because of the opportunity at generational wealth with that IUL. That MEC space in an IUL carries over and adds up year after year after year. Because of that, if you have a death benefit, when you pass away, that death benefit is going to pass on to your kids tax-free. And then they're going to be able to take that tax-free money and put it right into their IUL and fill up that MEC space that's been building that went unused. It's a great opportunity for generational wealth. And then it gets to grow tax-free, and eventually it's going to pass on tax-free to their beneficiaries. And the nice thing about our life insurance cash value, we have access to that with policy loans, right? So good opportunity for generational wealth. You can choose when to make that switch. Nicole is asking, how do you stop funding IUL after age 65? Good question. So an IUL is a flexible premium type of policy. You're not required to make any payments in any given year outside of whatever the minimum requirement might be at the beginning of the policy. And later on in the policy, as long as there's enough money to cover the expenses each year, then it's flexible. You don't have to put money in there. The insurance company just looks at the cash value in your account. Okay. As long as there's enough cash value in your account, when the insurance company needs to reach in and grab out the expenses, they don't care if you're putting new money into that policy or if it's just growing based on the value that's in the policy and the index growth, right? Or maybe you funded it a large amount at the very beginning and you never filled it back up, but there's still plenty of cash in there for them to keep pulling out those expenses year after year after year. With a proper design policy, we're going to have very low expenses. And it's possible that you fund it for 10 years, you've got enough cash in there to fund it for another 50 years without putting any new money into it. So you can definitely stop funding after age 65 as long as you do the projection, do an in-force illustration, and make sure that based on whatever your plan is, maybe you're pulling money out, maybe you're not, but make sure that there's enough cash in there to cover the expenses. The thing about after 65 is those expenses are going to creep up a little bit faster and a little bit faster because the only expense that should be in your policy at that point is likely the cost of insurance. And that's just going to go up every year you get older because the cost of that insurance is based on the likelihood that you're going to die that year. So every year you get older, it's a little bit more likely that that's going to happen. Hey, LaTanya, how are you doing? Jason, can I explain the 7-pay MEC test? Can you reduce life insurance after 7 payments? Is it better doing 7 payments versus 20 years for same amount of contribution? Good question. Okay. So the 7-pay MEC test, I did a whole video a couple of weeks ago, maybe it was about 3 weeks ago now, 4 weeks ago, on MEC tests. So I would urge you to go watch that. We are putting it together in a new video, not on my live stream, because it was on my live stream from a few weeks ago. But I'm going to condense it and we're going to have it come out titled All About the MEC or something like that. Okay, so that will help explain really in depth how the MEC works, and it shows you in numbers based on, I used an illustration to show you. There's 2 MEC tests. There's the guideline premium test and there's the 7-pay MEC test. Well, there's the guideline premium test and the cash value accumulation test. But the guideline premium test utilizes the guideline annual premium for determining the MEC limit, and the cash value accumulation test uses the 7-pay non-MEC amount. So that 7-pay, a MEC test is done over the course of 7 years. The first 7 years in a policy is your first MEC period. So whatever money you put into a policy, the maximum amount you put in any given year in those first 7 years is going to determine whether you're violating that MEC limit or not. Okay, utilizing that 7-pay non-MEC or the guideline premium. After those 7 years, you can recalculate those numbers. We can reduce the MEC test, but whatever number you hit for contributions during those first 7 years, we can't reduce it below that number. So let me give an example, because that was a little bit confusing, I think. It was almost confusing to me. Let's say that you get a policy designed with a $50,000 MEC limit. That means you can put in up to $50,000 each year in the policy. And you put in $40,000 in the first year. And then after that, you put in $10,000 for the next couple of years. And the plan was you were going to put in 50. That's why we designed the policy that way. And we started it that way. But things changed. Something happened. Let me switch screens here because we're not really looking at that question at the moment. So something happened and your plans change. You can no longer fund it at 50,000. You can only do 10,000. And so you say, James, I'm not going to be able to fund this at 50,000. Is there a way that we can make this more efficient? Well, there's a little bit of room for us to make this more efficient at that moment. If we're 3 years into it and you funded it up to 40,000 in one of those years, the MEC test has to be able to meet that $40,000 requirement. So this policy does not become a MEC. So we can reduce it. We can reduce the death benefit a little bit to bring that total MEC limit down to 40,000 instead of the 50,000 it was at. Now, that's not going to be very much savings, but it is possible to reduce it a little bit. Now, you might have been hoping that we could reduce it down to the amount that only allows for 10,000, but we can't quite do that yet. We have to make it that full 7 years before we can do that. Once we get past year 7, we can drop it down to a $10,000 MEC. So in this example, let's say that for that 50,000 MEC, it took 900,000 in death benefit. And for the 40,000 MEC, we only need 800,000 in death benefit. If we reduce that, that might save you, I don't know, $100 a year, $100 a year in expenses. So it's not a whole lot of savings. Because of how we design these policies, it's actually very inexpensive for that extra 100,000 in death benefit. So while that's good at the beginning, if you have a change that needs to be made, there's not much savings to be had by making that reduction. Now, one of the advantages is with the designs that we do, you are able to make that reduction generally without incurring any surrender charges. If you have a poorly designed policy or one that has much higher expenses because it paid out a bigger commission, didn't have a blended term insurance design, any reduction of the death benefit during the surrender charge period could incur a surrender charge. So it could be really expensive for you to actually reduce the death benefit a little bit with a poorly designed policy. Fortunately, with the policies that we designed, you have more cash value early on and you have more flexibility to reduce it if you need to. But of course, it's not a whole lot of savings that we're going to experience in that case. So, excuse me. Jason said, can you reduce the life insurance after 7 payments? Yes. And that's really what it boils down to. After those 7 years, you can reduce the death benefit to a certain amount, whatever the minimum allowable amount will be, but you want to make sure that your death benefit still allows you to fund it at whatever level you're planning on funding it. If you're done funding it completely, you can reduce it to whatever the minimum is that's required. Okay. And then finally, is it better to do 7 payments versus 20 years for the same amount of contributions? Generally, yes, because of how we do the design. So the design is kind of important, but also what's going to determine which one's actually better is the performance of the index. If we get that money in over 7 years as opposed to 20, we've got all of that money that's going to grow and potentially compound for an extra 13 years as opposed to spreading it out over 20 years. Now, if we spread it out over 20 years, we don't require as much death benefit. So our MEC limit could be a lot lower. But how much is that expense between the two? And we usually will run illustrations so I can actually show you the numbers and we can see what that difference is for your particular situation. So my assumption is yes, with the designs that we do, getting it in over 7 years, because of all of those potential years of compounding, it's likely much better to do that same amount of payments over 7 years as opposed to 20. Oftentimes, people might have a chunk of cash that they're looking to put in, and we'll look at what is the most efficient time period. And it's usually we're looking at less than 7 years. So they're usually like, can I dump it all in at the beginning? Well, you could, but it's going to require much more death benefit in order to get it in 1 year. It might be worthwhile. I mean, remember, you're going to have to pay for all that death benefit for 7 years. If you dump it all in 1 year, we can't reduce the death benefit below that MEC limit. So we're going to require a much bigger MEC limit to get it all in over 1 year. It could be worthwhile if the index performs really good beginning in that first year. But maybe it doesn't. We don't know what the index is going to do. Nobody does, right? So we've got to figure out what's the right balance between growth potential and minimizing our expenses. And usually that means let's take that lump sum and put it in over 3 years or 5 years. And that allows for a much lower death benefit. We don't need the MEC limit quite as high when we do that. And we still get most of the money in quickly enough that we can take advantage of some compounding that's going to happen. So that's usually what we end up doing. And we just run the numbers. And ultimately, it's up to the client to decide how they want to get it in there. But sometimes that MEC limit might be so high and the death benefit needed, maybe they don't even qualify for that much. That's always a possibility too. So those are just some of the things that we go through when we're trying to answer questions like this. Nicole asks, how do you turn off the expenses after age 65? There you go. That's a good question. So with an IUL, you generally can't turn off the expenses at all if you're going to still utilize the policy. There's always going to be some cost of insurance that you've got to pay. We can reduce the expenses a lot, but we can't turn them off. In a whole life policy, there's the ability to do a reduced paid up. That turns off the expenses in that policy. And from there, you can still continue to use the cash value like a line of credit. You can't put any new money into it, but you can pay your loans back, borrow again, and the policy will still continue to grow. So that's one of the things that we look at when we're trying to decide between whole life and IUL is maybe you want the ability to totally turn off those expenses as opposed to just making them very small. Now, in general, in the IUL, the expenses, we can make them really small. They don't seem small when we get to like age 90 because they're probably not, but they might still be small in relation to the overall cash value of your policy at that time. But around age 65, we can get your expenses generally down to like, $1,000 a year or $2,000 a year, something that's pretty manageable compared to whatever value we have inside the policy, which is hopefully by that time, hundreds of thousands of dollars. Now, there is a way to actually turn off the expenses after age 75 with most IULs. And there is one IUL at least that you can do it after age 65. And that's with utilizing the overloan protection rider. Utilizing the overloan protection rider, you're just going to borrow out as much cash value as they will let you, generally like 95 to 98%. And then you trigger the overloan protection rider and walk away with your money, and you don't pay attention to the policy after that. The insurance company is going to maintain a small death benefit until you pass away so the policy doesn't lapse. That's what the overloan protection rider is designed to do. So whether you accidentally borrow too much or you just purposefully need to take all the money out and go use it, and you don't want to have to worry about your policy, it effectively shuts off the policy. Now, you're not going to have any ability to access any more cash in that policy. You've borrowed it all out, essentially. They will let you pay the loan back or some of the loans back if you want to, but there's not really a reason why you would want to do that because you don't have access to borrow it out again. Okay. So essentially, you're only going to use that overloan protection rider if you plan on walking away from the policy. Now, I don't expect that we would need to use that unless it's an emergency, unless you've accidentally borrowed too much money. The worst case scenario in one of these policies is you're relying on the cash value to live on in retirement. You've borrowed too much money out of it for whatever reason, had to meet your bills, and you couldn't manage it any less. And your policy is going to lapse. And not only will you no longer have that money to live on, but you're going to get a tax bill on the gains after that. So you lose your policy because it lapsed because you borrowed too much. And now you have a tax bill to boot that you can't afford because you don't even have the money you need to live. That's why we like to have that overloan protection rider just in case something like that were to happen. You're still going to be out of money, but at least you're not going to get a tax bill to go along with that. That would be the worst case scenario. In general, we're going to try to come up with a plan for you so that you're not going to run out of money in retirement. But sometimes things happen. We don't, as the agent, we have no control over what you do with your cash value. At any time, you can always choose to withdraw the money. And that would also turn off the expenses. If you just take all your money out and walk away, you're essentially closing the policy. Now you're going to get a tax bill on the gains. You pay income tax rates on gains in that policy. If we don't do that, if we just borrow against the policy to access the cash values, there's no tax bills and it grows tax deferred. So that's why we like to use these things. And it's possible that you can utilize the wash loans rather than doing actual withdrawals and safely meet the needs of what you would otherwise withdraw for without having to worry about that tax bill. So those are things that we can talk about. If you ever get to that point, just know, get with your agent. You could talk about these kind of things and figure out what's going to be the best approach for you. So hopefully that helped answer your question there, Nicole. Let's go back to our questions. I'm still recovering a bit. My voice has been struggling for the last week because I was a little sick. And I can feel it starting to creep up here. And I do have meetings later today. So we're not going to go too much longer today so that I can preserve my voice. But we should be back again next Tuesday. We'll do some more of this. And I'm not going to be around Thursday for our whole life stream. But the following Thursday, I think we'll be able to get that going as well so we can talk whole life. All right, let's go back to these questions. We'll do a few more of these. And great questions. I love it when you guys are participating here in the chat. Okay. Jason had one more question here. Let's go back to that. I'm going to prioritize the comments here in the chat because we can get back to these other ones at any time. So Jason asked, what if the agent is no longer in business? Good question. So this happens often. This is a tough business. Agents will go out, they'll sell a policy. You'll think that you have that agent and they'll be available. And then they leave. Either they go out of business or they're forced out of business or whatever, maybe they die, right? I mean, I always tell my clients, I'm like, one of the reasons I go through the steps I do when I'm doing the illustrations with you and I'm educating you on this, I want you to know about these things because you could buy this policy from me and I could get hit by a bus the next day. And then what happens at that point? So the agent's no longer in business. The insurance company will assign a servicing agent to you. And that agent is not going to know what your plan is. They're not going to necessarily know how your policy was designed or why it was designed that way or how you plan to manage it in the future. Okay, those are all real things to be concerned about. So when I meet with people, I use this. There's this app that's a part of the Zoom when we do our Zoom meetings, and it automatically records and sends you a link to that recording. So theoretically, you can refer back to that recording if I get hit by a bus, and you can remind yourself what the plan is. When you get into older age, you can show that video to your kids. Get a copy of that video, show it to your kids so they know what your plan is. Whoever it is that's managing your money, you can show it to them. They'll know what your plan is and help you manage that. Because when you get into older age, you're going to get to a point where you shouldn't be managing your own money, right? So it's helpful to have those things. Now, in our case, we also have a team of independent agents who at some point have reached out to me from this channel and said, I like what you're doing and I love the business model that you have. I want to do what you do. And I say, sure, I'm happy to be your mentor. I don't have any employees, but I do take on independent agents that can come join my team. And you're going to find them on my website. I have a new website that we just released, and there's a list of team members on there. It's not a comprehensive list, but it's team members who have all returned all the information I've required so far. So if something happens to me, you could reach out to them and say, I would like you to be my servicing agent. Can you help me out? And they will help you out. So now you'll have an agent who knows how I design policies, who meets with me every single week. I meet with my team members every single week, and we answer questions. We talk about designs, and we talk about the different products and the different changes going on, and what does this rule mean and that. And I want to make sure that they're able to gain the knowledge that I have so that they can help their clients the same way I help my clients. Okay. And potentially, if something happens to me, maybe they can help my clients the way that I help my clients. That'll be the hope. And there's a wide range and there's a wide background. We've got a bunch of people who speak different languages. So if you have, let's say you have a family member that might only speak a certain language, you could go and look on my team member section and see if there's anybody there that might be able to speak to them in that native language. And it might be a good way to talk to that family member about this type of stuff, or give them somebody that they can work with more easily. So it's pretty cool. Check that out. And anybody who signs up, gets a policy, works with one of my team members, you've got access to me too. Okay, so I make myself available there. If you ever have any questions, you can go to them, you can go to me. Okay, you just tell them, ideally you book a meeting with both of us if you need to talk with me as well. But whatever the case may be, just know that you've got access to multiple resources. Okay. All right, let's see what else we have here for questions. So Michael asked, why did I go with National Life? So he was referring to my 3-year update. So this was in response to that video. This was the first IUL policy I bought. So that was the best product I had available to me at that time. So when I first started in this industry, National Life was like the first carrier that I got contracted with. I ended up getting contracted with a handful, but I was mostly focusing on annuities at the time. But I had the opportunity and the need to get some life insurance. And so I went with that one. It was actually a much better product at the time too, as far as cap rates on the S&P. It's still a good product, but the cap rates have come down a bit, and the bonuses aren't as attractive as like what we get with Allianz. It's still a good product though, and we can still design it pretty good. But a couple of years later, I came across the Allianz product, and that one just really blew me away with the guarantees, and then also connecting with Allianz and finding out how they do business and what that means to the product that they have to offer. And Allianz is my favorite product now. And so I've since bought an Allianz IUL as well. And I've been exposed to a lot of the carriers, most every carrier at this point, and what we can do with their products. So now I wouldn't buy a National Life product for me, but I am keeping my National Life product. Because it's still good. It's still a good product. And one of the advantages of National Life is their 4 living benefit riders. So in general, I don't put a whole lot of stock in the living benefit riders, but because I put more value into the cash value, but there could be a need for those. And when I look at my portfolio of life insurance products, that one's the only one that gives me all 4 of those at some level. So I still see a place for it, in my portfolio of investments. Here we go. Dave B asks, is it possible to do a 1035 exchange in later years when the cost of insurance goes up, maybe to an annuity? Absolutely. So I say definitely there's an option if the growth in the IUL doesn't continue to greatly outpace the expenses. So that I think that's key. We never want to just consider what is the cost of insurance is inside of a policy. We want to look at that in relation to how is our policy growing? Because if the cost of insurance could be, I don't know, $30,000 in a given year. But if you're making $300,000 or $400,000 or $500,000 in that same year because of that growth potential and the size of your policy, that's a small fraction. That expense is a small fraction of it. Those are generally numbers that we look at when we're looking out at around 90 years old. You might have to have a $30,000 expense for, $100,000 or $200,000 or $300,000 of insurance. Gosh, that sounds really expensive. Well, yeah, but the reason you have to have that much for an expense is because your policy is got $5 or $10 million in it, and the government requires a certain amount of insurance that the insurance company has at risk, so it's considered life insurance. We have to meet those minimums. So that's just part of the expense of owning that policy. Well, $30,000, if you've got a $10 million policy and your expense is $30,000, that's like 0.3% of an expense. You could choose to take your money out, do the overloan protection rider, take all that cash out and go invest it somewhere else. Are you going to find a cheaper cost from a percentage standpoint for an investment out there? Possibly. There's some ETFs out there that have or mutual funds that might have like a 0.1% expense, right? But there's no downside protection. There's no death benefit. It's not going to pass on tax. Well, it could pass on tax-free if you don't cash it out. But you get no downside protection there. If you're 90 years old, are you going to go manage that money yourself as well? Probably not. You're going to need to pay a financial person to do that. And they're going to charge you more than that 0.3% most likely. So we have to look at it in context. So yes, it is possible to do 1035 exchanges if the cost of insurance goes up. The downside to possibly doing a 1035 exchange is you still have to qualify for insurance. So you can't just do a 1035 exchange just because you own the product. You have to be able to qualify for the new product. That usually means you're not really old, and the cost of insurance is probably actually not that expensive. So there's a lot of things I think about when I see that comment, but just know that yes, you can do 1035 exchanges if it doesn't make sense to stay in your current product. So that's generally how I like to look at this. It's not necessarily the cost of insurance going up that might lead you to do a 1035 exchange. More than likely, it's going to be whatever product you bought, that insurance company is limiting your ability to get good growth out of it, or at least growth that you're happy with. Whether it's reduced caps, they may change the bonus options, they might institute other changes in the policy. If you look at the video of mine where I go over all the top IUL products, a lot of those carriers reserve the ability to make changes in that might not be very attractive, and it might limit your ability to get growth. So in those situations, you might consider a 1035 exchange. Jason asks, does it illustrate pretty accurately? Historically speaking, what's the average return after all the fees? Yeah, assuming you're doing the index. Let me switch back here so we know that we're answering a question in the chat, not on my screen. So is the illustration pretty accurate? They have been pretty accurate over the last few years. If you were to look at an illustration from a decade ago where the cap rates were really high and the law allowed an agent to illustrate 8, 10, 12% returns every single year in the policy, and then when you take loans, they could illustrate a 1% plus arbitrage, those are probably not very accurate because cap rates all came down steadily, over the last decade. I think what we're illustrating now, and I've generally illustrated at 6%. We could illustrate higher than that, but I've always dialed it down to 6%. I think those are pretty accurate, and they've been playing out fairly accurate as well. So when you say historically speaking, I would say probably not. They haven't been accurate, but that has more to do with what were the requirements then and how did insurance companies push the limits to make these numbers look really good. Right now, we're illustrating around 6%, and the historical return on the indexes with Allianz up around 10% with the lowest bonus option, close to 14% with the best bonus option. Those are actual returns, and we're illustrating around 6%. So I think there's a good chance we can outperform that illustration. Do we know if we're going to or not? No, I have no idea. But at 6%, we're going to be pretty happy with how that policy works because it looks really good even at 6%. If it outperforms that, we're going to be thrilled. If it does anywhere above that, I think we'll be thrilled. What is the average return after all the fees? So the fees vary so greatly depending on how that policy was designed. So I can't tell you after all the fees for a lot of that stuff, but Allianz does have a record of what their average return is among every IUL policy they owned, regardless of design, regardless of funding, whatever. And over the last, I think it's since 2006, the average return, if you've used an index option, any of their index options. So they didn't specify just this one or just this one. With all of their clients who've used an index option, the average return over that whole time, since that time period, so this takes into account all of the years and all of their policies, it's right around 7% is the average. If you did not, if you've just used their fixed interest option, which apparently some people have, the average return for that same time period was something like 4.1% or something like that, which is still really good. That's still a really good return. But I would assume those don't include the expenses because that would just be, I would think that would be entirely too hard to figure out because the expenses are just wildly varying. And it has so much to do with the design. So, all right, let's do one more question here because my voice, I can feel it going, and I've got other people to talk to later today. This one here, this was a good one. You know what? I'm going to come back to this one next week. There was one that I wanted to get to that Lonnie had. In fact, I'm just going to pull it up here. I had this saved. This was originally what I was going to work with. And I told her in my response, I was like, you know what? I'm going to do a video on this because there's a little more to this than I could get into in text on the response in the comment section. So she said, I don't remember what the first question was, but her understanding is she should buy the least amount of insurance the IRS allows, pay for it in the shortest time allowed, 5 years is what she had in here, for an IUL to be structured properly. Her goal is cash accumulation for kids' college tuition, not death benefit, which is what an IUL should do. If she could only afford to invest $20,000 a year, would it be better to max fund 2 policies, with each policy being $10,000 per year, for 5 years with the least amount of death benefit? So each policy would have a total of $50,000 premium. Or she gets another way to ask is if she only has $20,000 a year to invest, should she stop funding at 5 years so it can switch to option A? Okay. I remember the original question. The original question before this was, should she do a payment over 5 years or over 20 years? I think that was the original question. But let's just deal with this one here. So there's a little bit of a misunderstanding from whoever she got this information from to begin with. So the shortest time allowed is not 5 years. That is not the shortest time allowed. When it comes to your MEC limits, remember 7 years is our MEC test. So if you are funding it at $10,000 a year and that's your MEC limit, you could fund it for an additional 2 years for that same amount before you can make any reductions. So you can actually get 70,000 in. So I'm not sure where this came up from, the shortest time allowed being 5 years. I suspect it was listening to somebody like Doug Andrews, who likes to push for 5-year pays. I'm not sure why exactly he does that, but it's not a philosophy I subscribe to. Let's put it that way, because our MEC test is 7 years. Now, if you have a set amount of alarm going off. If you have a set amount of money to move into a policy, 5 years might be the best balance between expenses and potential growth. But it's not the shortest time period allowed. And you could potentially put all of that money in 1 year. And that might be the best way to go about it. We talked about that at the beginning of this video. That could be the best way to go about it if we knew what the index was going to do. But we don't. So we have to do a balance between the expenses and the potential growth. 5 years is a good period for that. So I don't have any issues with the 5-year period, but we want to make sure that we understand it's not the shortest time period allowed. Okay. Now, the least amount of insurance, yes, that would mean the MEC limit to allow for a 5 pay. That's totally fine. I think that policy would be structured just fine with what she's describing here. Okay. Now, next question. Would it be better to max fund 2 policies, each one being $10K, with the least amount of death benefit? Maybe. Basically, how I would look at it, the answer would be yes if you're getting a traditional design. So one like Doug Andrews does, where he does not reduce the agent commission. They don't do a split design where they blend in some supplemental term, and you have an optimum design where, let's take Allianz as an example. Allianz allows us to do a 10-to-1 split. 100,000 base face amount, that's the commissionable insurance. And we can blend in 10 times as much. So we can blend in $1 million with that doesn't pay any commission. So we have a total death benefit in that case of 1.1 million. That's our scalable amount. You could have a $50,000 MEC limit with that one policy that pays out a commission based on a $100,000 death benefit. That's going to be more efficient than 2 policies that are designed. Oh, I had 50,000 in my head but it's 50,000 total over 5 years. But the point being, that would be more efficient for putting in 50,000 a year as opposed to doing 2 policies at 25,000 a year, where you have 100,000 base in each of those 2 policies. So we doubled the commission essentially to go with 2 policies. That same thing would happen with this type of design. So we know with Allianz and with most of our carriers, there's a $100,000 minimum for that base face amount. And that base face amount determines the commission. So if we do 2 policies, and in this case, to have a $10,000 MEC limit, we might only need $250,000 in death benefit, maybe $200,000 in death benefit. That means we have $100,000 as our base face amount, and we blend in an extra $100,000. And we do that for 2 policies. So we're doubling the commission to have 2 policies in that situation, as opposed to just doing 1 commission, 100,000 base, and add 300,000 of non-commissionable to that 1 policy. And then we only have 1 commission. Now, I'm simplifying things a little bit when I just talk about the commission, because it's kind of an easy way to think about it. Target premium is what determines the commission. And an agent generally makes about 100% of target premium. Okay, it's an easy way to think about target premium. But that target premium is basically what determines the bulk of the expenses in the early years of a policy. It directly relates to the amount of surrender charges and how much per unit charge you're going to be paying. Okay. That per unit charge is really high if you have a high commission. It can be very low if you have a low commission. So essentially, if we double the target premium by doing 2 policies, we're doubling that per unit charge. Okay. And that per unit charge is something that's recouped over 10 or 15 years, depending on the carrier. But it's going to be substantially more than whatever that target premium was, because it's not just my commission that goes into the expenses of that policy. It's the commission to me, the commission to the agency that contracted me with the carrier. It pays for all the underwriting and the medical exams and ordering the medical records. All of that stuff gets taken into account, but it's all determined based on that target premium. Okay. So the easy way to think about it is the commissions. Does that make sense? So my answer to this question, it's really too hard for me to explain that in text, that it may not be the best way to go about it, to split it up at 10,000 per year. It's a lot easier when I meet with this person, I show them, because I can actually show them, okay, here, look at this. If we put in 20,000 per year in one policy, as opposed to 10,000 in 2 different ones, here's your potential savings. Now, it might be worthwhile to still go with 2 policies, because there could actually be a death benefit need. If they don't already have death benefit coverage, then it's a good idea to have some coverage on both parents, which would be the case if you did 2 policies in this. It could be worthwhile. And because we do a reduced commission design of a policy, it's probably still not that big of a commission. So even though we're paying double, it might still be reasonable enough to go with 2 policies as opposed to 1. But it's not the most efficient way to do it. And one of the things that the people I meet with often hear is, after I show them this is the most efficient way to do it, I show them you might not want to do it that way because you might have a need for a better death benefit. Or you might have a need for a death benefit on each person. But my goal is that they make that decision based on knowing the differences, knowing what goes into that and the actual cost, not me making the decision for them and by hiding information, basically. So that's just the way that I do business, right? I want to make sure that you have the tools to make the right decision for you. Now I can give you some advice, and you can ask for my opinion, which one you want, or which one I think you might be better off doing. But ultimately, I want you to have that information so that we're in agreement. Or ultimately, you go with what you want to do and not necessarily what I would recommend without knowing why I recommend it, right? So with that, I think we're going to wrap up today's meeting. Like I said, I'm going to save my voice. But I do appreciate you guys joining me. I love the questions. Appreciate the interaction here. Hopefully you found this of value. Do tune in. If you ding the notification bell, you'll get notified. If you subscribe and ding that notification bell, you'll get notified when we go live so that you can ask your questions. Whether you're a potential client looking for more information or you're an agent looking to learn these things better, I welcome all of you guys. Come in, ask your questions, sign up for a meeting with me if you want. The link is scrolling along the bottom here below. Happy to meet with any of you whenever I have the opportunity. So take care, and we will see you next time. Have a good weekend, everybody. I guess we're not even close to the weekend, but I'm not going to be live again before this weekend. So have a good week and a good weekend, and we will see you next week. Thanks.